to another episode of Smart Money Millionaire. I'm West Cohan, certified financial planner, and today we want to talk about the number one mistake that investors make. Managing about $40 million for my clients, as well as my personal portfolio for over a decade, means I've seen or committed just about every mistake that an investor can make. Whether it's falling for the hype on the latest red-hot undiscovered penny stock, or buying an asset that you don't fully understand, Bitcoin, or trying to outsmart the market with your 200 IQ genius stock picking skills, there are a lot of ways you can be your own worst enemy as an investor. It's important to note that in life, making mistakes is inevitable. Just like that time I thought it would be a good idea to grow a ponytail. Sometimes you get it right, and sometimes you guarantee that no member of the opposite sex will want anything to do with you. The good news is that in life, it's not about the mistakes that you make, but how you learn and react to them. Some mistakes can be small, valuable learning opportunities that are relatively inconsequential to your long-term goals and a successful retirement. For example, let's say you wanted to buy an ETF of the S&P 500, but you didn't fully understand the concept of expense ratio, which is the internal fee or cost associated with owning an ETF or a mutual fund. So you go out and you buy an ETF of the S&P 500, but it has an expense ratio of 0.09% instead of something like 0.03% that you could have bought if you purchased a best-in-class ETF such as Vanguard's ticker VOO. Now in this scenario, you are picking a fund that's 3 times more expensive than what the best-in-class offers. However, it's really not the end of the world because we're only talking about a difference of 0.06% per year. So if this is a $100,000 portfolio, that's only a difference of $60 a year in fees. So while it's not great, it's really not a big deal in the big picture, and as long as it taught you to learn about expense ratios, you'll be better for it long term. Now, on the other end of the spectrum, some mistakes can be incredibly costly, like driving drunk, having unprotected sex, or playing World of Warcraft.
You can't go to the bathroom, you're stacking Sunder Armor.
Never again. Same thing is true in the investing world, where a small handful of serious mistakes can be catastrophic to your financial well-being and your future retirement. So what is the number one mistake that investors make? I got you, fam. Drum roll, please. The number one mistake investors make is letting emotions drive your portfolio. Specifically, you should be careful of 2 of the most powerful emotions, fear and greed. Now, I know a lot of investors right now are feeling shook, scurred, and a little uncertain about their portfolios. So today, we wanted to talk about fear and provide some real-world examples of how fear can be a terrible, terrible thing for your portfolio. So let's imagine you had $400,000 in your portfolio at the start of the year, and then your portfolio dropped 30% because of a worldwide global pandemic or some other market downturn, and your portfolio dropped from $400,000 to $280,000. The natural human instinct or response in this situation will be something like, "Holy shit, I just lost a lot of money. That does not feel good. I'm feeling sick. Please make it stop. Lord, please, Lord, save me, Lord." Or something like that. And to make matters worse, while your portfolio is sucking the hind tit, the financial news on TV is absolutely terrifying and seems to get worse every day.
because, of course, the Dow plummeted 2,014 points, its worst point drop ever.
So in an effort to protect your portfolio, you decide to sell, get out of the market before it drops any further. Phew! Whew. You feel like you've protected your portfolio and the worst of it is over, right? Except what happened during the 60 days after the market hit its bottom on March 23rd of 2020? Uh-oh, SpaghettiOs, motherfucker. The market rocketed back up over 30% in less than 60 days. So now, you lost money on the way down, you sold and got out, now the market has rocketed back up and you've missed some of that recovery. So now you're starting to get a little itchy and you're starting to get some FOMO about missing the entire recovery. So what do you do? Well, let's take a look at what your two best options would be in this situation and play that horror movie out. So let's go ahead and take a look at option number one. After you decided to sell, the market has recovered over 30%, with the S&P 500 posting its best April performance since 1987. Every day the market lifts has you questioning if you made the right decision to sell. All of a sudden, the financial news and media is not quite so scary. Now your FOMO has hit maximum levels, so you decide to go ahead and buy back in at the current prices where you're about halfway through the recovery. Now, investment gurus always talk about how you should buy low and sell high. In this instance, you've just done the opposite. You sold low and you bought high. So that's obviously no bueno, but let's take a look at what happens after you buy. If the market continues to recover, well, that's not so bad, but you still would have been better off not selling in the first place. But what happens if the market drops again after you bought? Are you going to have the courage to ride through that downturn? Or is it going to make you feel like, this is the big downturn that I knew was coming originally. I knew I was right. This is just a little bit later than I expected, but you're not going to fool me again. I'm going to get out of the market before I drop down again. And then you've just put yourself in the same cycle where you're panicking and selling when the market goes down, and that's not a good place to be. Now let's take a look at option number two. The markets have recovered about 30%, but you decide you're not going to buy, you're going to stick to your guns and sit in cash waiting for the bottom of the market. The problem with this approach is that timing the bottom of the market is impossible to do reliably over a long period of time. It's a very dangerous game to try to time the bottom of the market, and we do not recommend you mess around with that. On the other end of the spectrum, what happens if the market continues to recover and the downturn never comes? Now you're going to be stuck in cash, earning 0%, and you're going to be missing the recovery, stuck chasing it. So as you guys can see, all of the outcomes here in these two hypotheticals are not desirable. You would have been much better off not panic selling and just staying the course. Now I'll save this for another video, but just a quick note on greed. Greed can be just as dangerous for your portfolio as fear. Trying to get rich quick overnight is an excellent way to torpedo your portfolio. They say in the investing world that pigs get fat, but hogs get slaughtered. So while letting emotions judo chop your portfolio in half can be very painful financially and emotionally, it is possible to learn from this experience and to go on to be a successful long-term investor. However, some investors will never recover from a mistake like this. In fact, the absolute worst outcome from emotional investing is that you get burned so badly that you never want to invest again. You decide that the markets are too scary, too dangerous, maybe the markets are rigged, but you just can't handle it. So you never buy another stock in your life. This is a huge mistake that can be catastrophic for your financial well-being and your future retirement. So not only did you lose a lot of money by making a decision based on fear, but now you've mind-fucked yourself so hard that you have forfeited all future gains. This is the absolute number one mistake you want to avoid as an investor. And we saw this quite a bit in 2008 during the Great Recession. Many investors, after their portfolio dropped 50%, exited the markets and never got back in. So they missed the longest bull market in history, where the S&P 500 rose over 334% over a 10-year period. And this might sound a little unrealistic to you, but I am telling you, I have many clients, most of whom are very intelligent, successful, wealthy people who have been scarred so badly by losing money in the markets like this that they refuse to own stocks. So how do you stop your emotions from getting the best of you? Well, it's pretty straightforward. You want to develop a comprehensive investment strategy and philosophy. You want to remove emotion from your decision-making process. You want to stick to the script. And basically, you just want to buy and hold. So how do you apply all this advice to the current market? Well, if you're a long-term investor who should own stocks and your portfolio is down right now, don't panic sell. Do not panic sell. Resist the temptations to let fear drive your portfolio, and resist the temptations to try to time the market and dodge a big downturn or anything of that nature. We like to tell our clients that time in the markets will outperform timing the markets. That means if you just buy and hold, you're going to do a heck of a lot better than if you try to jump in and jump out trying to time the tops and the bottoms. Quick disclaimer, while I am a licensed financial advisor, I'm not your financial advisor. This video is for educational purposes only. That being said, we hope you learned something useful today. If you have questions about your specific